How would you define a person who is wealthy? Think about it. Is being rich just about having millions of dollars? If so, why do 70% of lottery winners end up broke? Robert Kiyosaki, the author of the book Rich Dad Poor Dad, defined wealth as the number of days you can survive without physically working, or anyone in your household actually working, yet still maintaining your standard of living. A high living standard will require a larger income or fortune to sustain you for a long period. If you want to become rich, and equally important, stay rich, you need to understand the difference between assets and liabilities. In this video, we will teach you the difference and explain why it is so important for your financials. Understanding the key difference will change your financial future. Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. You might have heard people talk about assets and liabilities, but not really understood what it is. You might have also asked yourself, how do I know how to determine whether something I own or buy is an asset or a liability? The short and simple rule is that an asset is something that generates money or increases in value, and a liability is something that costs money or depreciates in value. In a nutshell, an asset will put money into your pocket, and a liability will take money out of your pocket. But if it really is that simple, why do most people only acquire liabilities? Buying something that generates money might sound like a fairy tale, or even something illegal. Usually we spend our hard-earned money on the necessities in life, like food, shelter, clothes, and transportation. When the necessary expenses are covered, we tend to spend the rest of our paychecks on the things we enjoy in life, like vacations, entertainment, luxury objects, maybe an extra car, a holiday house at the beach, or a new boat. All of these things cost us money, and most of them will be impossible to sell again for a price even close to what we paid. What's more is that some of these items, like the boat and the extra car, will require more money as time progresses on insurance, maintenance, and more. That's the definition of liabilities. Things that in fact make us poorer, even though a new sailboat might make you look rich. The funny thing about us humans is that we tend to constantly match our spending to what we earn. If you earn more money each year, that doesn't really make you any richer long term if you keep increasing your expenses accordingly. That is also why most lottery winners actually end up broke, because they suddenly get used to having enormous amounts of money and increase their spending accordingly. Without the knowledge on how to acquire assets with that money, your wealth will be very short-lived. With this in mind, what is an asset? As we explained at the start of this video, an asset will put money into your pockets. There's several types of assets, but the most common types are known under the term investing. As we covered in a previous video titled What is Investing, there are several types of investments, ranging from stocks to real estate and index funds. We will cover index funds in a future video, so make sure to subscribe to the channel and press the like button. It really helps out the channel and enables us to reach more people and help them start their investment journeys. It is sometimes easier to see the fundamental difference between assets and liabilities with an example. This will also illustrate the shocking difference it can do to your financial future. In our example, we will look at Karen and James, two individuals with an average annual salary. They both inherit $200,000 to manage or spend as they wish. James simply loves cars and decides to borrow an extra $50,000 from the bank to buy a brand new Lamborghini Hurricane for $250,000. The bank gives him a 5-year car loan with an interest rate of 7%. The loan will cost him $300 a month, just in interest. This will total to $3,600 the first year. His monthly payment to the bank will be just under $1,000 when we include the principal. Karen doesn't really need to buy anything with the $200,000 right now, and she has recently read about investing in the stock market. She decides to invest $100,000 in a global index fund. She also has a friend that has told her about real estate investing. She contacts her friend and she helps her find a suitable rental property for the remaining $100,000. She rents it out for $600 a month, and the monthly cost of owning the property averaged to $300. which means that Karen can put $3,600 a year in her pocket, in addition to the expected appreciation on the property value. After 1 year, James's luxury car has depreciated in value by 20%. His expenses on the car loan total $3,600, and the remaining car loan is now at $41,500. This means that James has turned his $200,000 into $155,300, and that is not including costs for insurance and maintenance. It is safe to assume that James has lost almost 25% of the original $200,000 in just 1 year. Karen, however, has better news. The value of her position in the global index fund has increased with 10% to $110,000. This might sound like an unreasonably high return, but it is in fact just in line with historical returns for the stock market. The property market has not generated the same returns the last 12 months, and the value of the property has only increased by 5%. Remember, however, that she has also rented out the property for a total profit of $3,600 the last year as well. The property investment has thus delivered Karen $8,600. In total, Karen's $200,000 investment into 2 different assets has increased to $218,600. This example is fictional, but it does illustrate 2 very different ways you could handle an inheritance, or if you win the lottery. In general, even with a high income, we claim that living out of your means will make you poor. But if you invest and make sure to grow your assets, you will be able to achieve financial success, especially if you are careful with your liabilities. In summary, we have defined assets as anything that will put money into your pocket, either directly or by appreciation. Liabilities will take money out of your pocket and drain your possibilities to becoming wealthy. Fill your life with assets and avoid liabilities. If you do end up with liabilities, try to find a way to turn a liability into an asset. That is the topic for our next video. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.